There's a lot of excitement about Palantir reporting on big retail investor interest, also seen as one of the leaders when it comes to AI software.
Palantir Technologies has officially entered the big leagues, and I mean big. As of this week, the company is trading at a market cap of nearly $294 billion. And before you even ask, yes, that's more than Intel. In fact, it's worth more than Zoom, Shopify, and Snowflake combined, all of which we'll discuss later in this video. But here's what really makes investors sit up and sweat a little. Palantir is now trading at more than 75 times its projected revenue for 2025. Let that sink in a little. For every dollar it expects to earn this year, the market is paying $75. This kind of valuation isn't just aggressive, it's borderline mythological. You'd expect this from a biotech stock with one miracle drug, not a 20-year-old data analytics company that used to be a niche government contractor. So today, we're asking the real question. Is Palantir the next great tech titan, or is this just another member of the 30x revenue bubble club? A club that's already claimed some high-profile victims. Think, as I mentioned, Zoom, Shopify, and Snowflake. We'll walk through their rise and painful reversion and compare it to what Palantir is doing today. We'll also pull in ServiceNow, a company that took the slow and steady route and still won. So let's start with the club Palantir just joined, the high multiple growth elite. The price to sales ratio, or PS, tells us how much investors are willing to pay for each dollar of revenue a company generates. Most healthy tech companies, ones that are still growing fast, trade between 8 times and 15 times sales. Anything above 20x, that's rarefied air. So when you see Palantir at 75 times revenue, your eyebrows should go up. Now, to be fair, this isn't unheard of, it's just dangerous territory. Here are the legends of this club. Snowflake, at IPO, it crossed 100 times revenue. Investors couldn't get enough of its cloud-first data lake vision. But reality kicked in. Today, it trades closer to 20x, and it's still considered expensive. Now, Zoom. At the height of the pandemic, Zoom became a household verb. It was the lifeline for every boardroom, classroom, and family trivia night. Investors pushed it past 50x sales. But as work-from-home enthusiasm cooled, so did the stock. It's now sitting at a humble 4x revenue. Now, Shopify. During the e-commerce boom, Shopify was hyped as the anti-Amazon, a platform empowering the little guy. At its peak in 2021, it was trading above 40x sales. But post-COVID growth fizzled. The stock dropped over 80% from its high and now trades closer to 10x. Each of these companies had real businesses, real growth, and at the time, a really compelling story. But the moment that growth slowed or expectations got too far ahead of fundamentals, the market made them pay. So where does Palantir fit in? All right, let's break it down. First off, Palantir is no longer a speculative AI moonshot. The company is profitable, it's scaling revenue fast, and it has a foothold in both government and commercial sectors. In Q1 2025, Palantir reported revenue of $884 million, up a solid 39% year over year. They raised their full-year guidance to as high as $3.9 billion, and if that holds, this will be their best growth year since going public. Now, what about profits? Well, glad you asked. Palantir posted net income of $214 million. That's a 24% margin. Not adjusted, not community earnings, we're talking real, honest profits. They also generated $370 million in free cash flow last quarter. So yes, they're actually printing cash. This is no longer a burn-heavy growth stock, it's a business. And the bulls would argue, this isn't like Zoom or Shopify. Palantir isn't reliant on one product, one customer base, or one trend. It's a platform company with fingers in defense, AI infrastructure, logistics, health, manufacturing, and more. It's also arguably the best placed pure-play AI company that's not already inside big tech. So why is the multiple still concerning? Because even the best story has to grow into its valuation. And 75x revenue is a very, very large shirt to grow into. Palantir started as a government-focused analytics firm, powering US intelligence and military missions. That work still dominates. In Q1 2025, US government revenue hit $373 million, up 45% from the prior year. But what's new and arguably more important is the commercial growth. Commercial revenue in the US grew 71% year over year, now over $1 billion annual run rate. That's explosive. And what's fueling that growth? Palantir's artificial intelligence platform, or AIP. That's not a science experiment, it's real. Customers are deploying it and they're paying big dollars. This dual engine defense and commercial is what gives Palantir more resilience than previous high multiple names. Zoom didn't have that. Shopify didn't either. Even Snowflake, while sticky, lives almost entirely in the commercial IT stack. Palantir has contracts with NATO, the Pentagon, global pharma companies, and auto manufacturers. It's a much broader footprint than most people realize. Palantir is clearly doing a lot of things right, but the expectations baked into the stock today are massive. The company is still valued as if it will be continuing to grow at 30 to 40% annually for the next 5 to 7 years, and expand margins to big tech levels, and avoid any hiccups in a highly competitive AI market. Now that's a tall order. And if we've learned anything from Zoom and Shopify, it's that when growth slows, even just a little, multiples can fall off a cliff. So let's rewind and look more closely at what happened to the previous champions of the hypergrowth and hype club. Because if Palantir wants to avoid the fate of Zoom, Shopify, and Snowflake, it's worth understanding where the wheels can come off for them and whether Palantir is driving a different vehicle altogether. Let's start with Zoom. When COVID hit, Zoom was just a product. It became part of the global vocabulary. The stock ran from $70 to $560 in under a year. That's a price to sales ratio past 50x. Everyone from day traders to hedge funds piled in. But Zoom was never built for hyper annual growth. It had a moment, not a movement. When that moment passed, so did the valuation. Revenue growth slowed, customer churn ticked up, enterprise sales stalled, and the PS ratio compressed down to around 4x. Same thing with Shopify. It was hailed as the savior of small business, the great Amazon alternative, but it couldn't live up to its own narrative. At its peak, Shopify traded at 40x revenue with little profit to show for it. Once interest rates rose and e-commerce normalized, investors started asking hard questions about cost structure, scalability, and margins. The result, the stock fell from over $1,700 to $300, and now trades at a more modest 10x revenue. And Snowflake, the cloud data darling, while still a strong business, its 2020 IPO hype carried it over 100 times revenue. Today, it's still growing, but investors now value it at 20x, a huge haircut from its euphoric peak. So what's the pattern here? High multiple stocks break when growth slows and expectations remain high. The bigger the story, the harder the fall, if execution isn't flawless. Now let's contrast that with ServiceNow, the stock Palantir should aspire to emulate. ServiceNow never got swept up in pandemic mania. It wasn't flashy, it wasn't buzzy, it didn't get 40x revenue. In fact, it's never traded above 20 times sales. But it kept doing one thing right: execution. Every quarter, ServiceNow delivered solid enterprise growth, sticky customers, expanding free cash flow, and high renewal rates. No headline hype, no wild multiple swings, just steady compounder behavior. And guess what? It's now worth over $200 billion, and institutions love it. Because even though it never excited Reddit, it earned Wall Street's respect. Palantir, if it plays its cards right, could thread that needle between ServiceNow's financial maturity and Snowflake's technological edge. But that brings us to the hard part: risk. Now let's not ignore that, because when you're priced for perfection and 75 times revenue is absolutely that, there's zero room for a stumble. Here are 4 things that could derail this story fast. Slowing US government growth. Palantir's legacy strength is in defense and intel, but if political budget cuts hit or defense contracts shift, the company could lose a chunk of high margin revenue. Next, AI hype cools. Right now, AI is the hottest acronym in the market. But if interest rates wane, or if competitors like Microsoft, Google, or emerging startups start winning deals, Palantir might look more legacy GovTech than bleeding edge innovator. Number 3, commercial momentum fizzles. Yes, commercial growth is hot right now, up 71%. But is that sustainable? Early adopters are excited, but can Palantir convince the broader enterprise market to rip out their old systems and go all in on Foundry and AIP? And finally, valuation shock if Palantir misses just one quarter, or even just guides conservatively. That 75 times revenue number could drop to 30x overnight. That would be a 50% haircut to the stock price, even if the business is still strong. All right, enough doomsday. Let's talk about the upside, because Palantir's bull case is legitimately exciting. Here's the play. Revenue grows 30 to 40% annually over the next 5 years. Commercial adoption explodes globally. Government contracts expand into NATO, allied nations, defense, and tech. AI becomes embedded in every vertical, and Palantir becomes the go-to operating system for large-scale AI deployment. That kind of outcome could support a 50x to 60x sales multiple, or even more. If margins expand and free cash flow stays strong, in that world, a $300 billion company isn't crazy. In fact, it could be conservative. So we're really looking at a high conviction, high volatility setup. Let's put some numbers around it. Assuming 2025 revenue hits $3.9 billion, here are 3 realistic valuation paths. The bull case is obviously that price to sales remains steady at 75. The stock price isn't really going to do a whole lot. The base case, price to sales multiple comes back down to between 20 and 25. Valuation goes down to 90 billion and the stock price at 40. A bear case, a PS multiple of 12 to 15, a valuation of 55 billion and a stock price at 25. And remember, the stock is currently trading at 125 a share. So unless you believe Palantir grows into a 10 billion revenue giant by 2029, you're paying forward a lot of optimism. Palantir is a fascinating company. It's profitable. It's got strong top-line growth. It has real differentiation in a noisy AI market. And it's no longer just a defense contractor. It's going head-to-head with the likes of Microsoft, Oracle, and even AWS in enterprise software. But that valuation, at 75x revenue, the market's telling you this is the next great software platform, and we believe it now. The danger isn't that Palantir isn't a great company. The danger is that even great companies can get priced for perfection and still disappoint. So is it a bubble? Not exactly. Is it risky? Absolutely. But is it worth watching or even betting on? Well, if you can stomach the volatility, maybe. Because one thing's for sure, Palantir isn't just selling software, it's selling the future. The question is, how much of that future is already priced into the market? Now, if you made it this far, don't forget to like and subscribe for more US stock analysis, and we'll see you in the next video.